We have a strong technical in the high yield market right now. We have cash balances that are trending towards the high end of the range across the market, where we've had outflows, but a lot of those outflows have been funded via the cash on hand. So we haven't had this massive wave of selling pressure hit high yield this year. On the flip side of that, we've got a new issue market that's coming in well below average. So we're right around 100 billion total in the primary issuance so far year to date. That compares to a 10-year average of right around 300 billion per year. So we also haven't had this massive wave of supply. Those two things together lead us to have a relatively supportive technical in high yield. And then when you take a step back and you look at high yield about a year and a half ago, we had dollar prices that were 104, 105. We had spreads inside 300, all-in yields right around 4%. And then here we are today where we have a dollar price that has gone from the 104, 105 level, is down in the mid 80s. So we're starting to have this convergence of dollar price into recovery rate, which is also adding to the strength in the technical and the high yield market. So the current high yield market is more of an up in quality market than we've traditionally seen, meaning we've got more double B constituents and less triple C constituents in the index. And what we saw over the course of 2020 and 2021 was a large amount of refinancing happening in the market. So what corporates did effectively was they really pushed out their maturity walls. When we look at the maturity wall now, the thing that concerns us in the high yield market is a maturity wall that's going to hit in 2025. So they've given themselves a good 18-month runway where things look pretty smooth from a refinancing perspective. The other thing when I think about cracks in the high yield market are defaults. And we're in an environment right now where defaults are at below 2%. I don't think there are many people in the market that are calling for that number to increase substantially over the course of the year or during that 18-month runway. So I do think we're in a pretty good position from that perspective in terms of flushing out any cracks in the high yield market. With all-in yields approaching 9%, default rates at historic lows, my opinion is that high yield will screen well across other asset classes. The issue of when to buy high yield is going to be your ability to buy high yield, which we found to be a little more challenging over the course of this past year. So if an investor has an idea of where they think high yield is attractive to them, the thing they have to ask themselves is, how am I going to be able to get the risk on? From the trading desk perspective, we think the best way to approach that is to average yourself in as you get closer to your target rate of when you think you should be buying high yield risk.